Welcome to Markets Now. I'm Michelle Worker along with Ted Seifried with Zaner Hedge, and we ended lower in livestock and energies, but the grains to the plus side and wheat led the rally, Ted, and certainly that was on some of these Black Sea War headlines. And talk about what the headlines were and what it might mean for the Black Sea grain deal first off.
Yes, Michelle. More headlines from the Black Sea, and you know what? This is the first time in a little while that the markets have had much of a response to headlines, and that's because this is kind of a big one. What it was is there was a drone attack on the Kremlin, purportedly or specifically to try to assassinate President Vladimir Putin. There were two drones that attacked the Kremlin. Now, the Russians say this was the Ukrainians. Ukrainians haven't fully taken credit for that. So, very interesting development. But the point of it is a direct attack or an attempt at a direct attack on President Vladimir Putin might really go a long way to escalating this war even further than it
Yeah.
has been. And when you start talking about like the grain corridor, for example, Russia's already been really threatening to back out of that on the 18th. This probably makes that conversation even more difficult. So that would suggest that less Ukrainian exports moving by ship, meaning less, just really less wheat and corn in the world to go around.
Yeah, so let's talk about the key reversal that we had in the wheat market and whether we can build on it. And does this effectively maybe put a bottom in that market?
It might, Michelle. Funds are technical traders, but from a technical standpoint, a key reversal doesn't always mean the absolute bottom. When I see a key reversal, what I think is that, hey, this is a big red warning flag saying that a trend might be about to change, or this is the beginning of a trend change. Now, due to the nature of this key reversal, because it was a news driven key reversal, it might actually put in a bottom. We'll have to see. But the funds are technical traders, and when they see something like that, it definitely it throws up a red flag for them to be a lot more cautious with their short positions and may cause short covering. And if that happens, this could have some legs underneath it, Michelle. I got a
So the
call. It was my
corn
fault.
market followed wheat, and we actually saw just a little bit of a reversal there, although it wasn't a key reversal. But do you think corn can build on that as well?
Yeah, so not a key reversal, Michelle, because we didn't make a new contract low in any of the
Right.
corn contracts. But it was a very nice reversal or outside reversal higher day. And when you've got a very oversold December corn market and a very oversold July corn market, this can go a long way to getting the funds out of their short positions. Now, their short positions in corn aren't as massive as they are in wheat. They have really just kind of started to get short corn again. But the funds aren't your only technical traders. I mean, there's been a lot of people looking for a bottom in corn. We felt like maybe this recent slide has gone too far. A lot of this was based on Chinese cancellations, so we'll see what export sales has to say about that or how that's reflected on export sales. But seasonally, we a lot of times have a tendency to rally to put in a weather premium here at this point, Michelle. You can maybe say that we're already at prices that don't need a weather premium, but after the recent slide we've had, I would think that we would see a halfway decent bounce here. So I'm hoping to see a halfway decent bounce in the July and December contracts in corn.
Yeah. Now, soybeans obviously followed as well and got some spillover support from corn and wheat, but we previously or initially today dropped below the March lows and then closed back above them. How strong of a technical signal is that?
Yeah, so we still have that outside reversal down day in soybeans from just 2 days ago that we have to negate that first, and so you
Okay.
you don't have a strong buy signal on a soybean chart based on what happened today alone. That being said, I would think if wheat and corn are going to go, beans are going to try to follow along. The problem that beans have right now is Brazil. Brazil is offering soybeans at a much bigger discount, or at a very large discount compared to what we are offering soybeans on the export market. So our exports are gonna, well, they're gonna suffer going forward. They're gonna have a hard time finding traction outside of the normal logistics, like say rail to Mexico. But putting soybeans on a ship, we've got way too much competition at the moment for that. So soybeans could follow, but if they do, I think they'll be reluctant followers.
Yeah. Otherwise, we're going to be dealing with this Brazilian crop here for quite a while in terms of competition, aren't we?
Yeah, and for soybeans, absolutely. I mean, really, through the end of our marketing year, unless there's a big port strike or something that we haven't seen yet coming out of Brazil. But yes, that is going to be an issue. At least for corn, they're not going to be too much of a problem until they get to the end of their second season safrinha corn crop, which is really in July. So there, we do still have this window of opportunity to be exporting corn, to making export sales for corn, but it doesn't help when you get China cancellations. So hopefully that's the end of that. The market is still a
Yeah.
bit nervous about it. We haven't seen any since last week. So maybe we're able to shake that off and go forward. It would be really nice to see an export sales report that more than offsets the Chinese cancellations, whether it's new business from China that we just didn't see on a daily wire or other countries coming in and stepping in to buy corn. That would be great. Corn has been on sale the last 10 days or so.
Right.
So yeah, we'll be hanging on that export sales report.
So the other big news was the Fed action. Not that it was a surprise. The quarter basis point or the quarter percent was pretty much expected. And now everybody wants to know, is the Fed going to take a pause? And if they do, can we get some of these specs to come back here into the commodity sector after they've exited so much of the sector?
Yeah, and like you said, everybody expected a quarter point hike. We were all waiting to see how the Fed's language would maybe give us clues into what's going to come into the future. And I gotta say, the language that they use really didn't give us any major direction. Which could actually be a good thing because the last time the language they used was saying that if it's appropriate, we will continue to raise rates. It sounded like they were leaning towards continuing to raise rates, which is why we were expecting it. This time, they said they will be monitoring the situation closely, and it may be appropriate to take further action. But they didn't single out rates, and that could mean they do something on the quantitative easing, really the quantitative tightening side of things. They've had to do a lot of quantitative easing recently because of the bank liquidity issue that we've had, the banking crisis, so to speak. And if they were to start to reverse that, signaling that the banking situation has gotten better, or at least the worst of it's behind us, then yeah, indeed, I do think the funds are going to come in fairly aggressively, feeling like the water is safe again and that inflation has not completely gone away and that they do need to be exposed to things like commodities that do carry
Right.
inflationary traits when things are going higher.
Yeah, we've certainly been hit by this risk off selling pressure across the grains. Cattle futures still feel like they're kind of trying to digest some of that. And of course, we took out some key support today in the June. Cash and cutout values have now been lower. So, do you think we're going to see a bigger correction here?
We've been due for a bit of a correction, and so this isn't terribly surprising. And a lot of it has been sparked by worries about the economy. I mean, look at what crude oil has done. I mean, there is a lot of risk off and a lot of concern. But when we're concerned about
Right.
the economy, we also get concerned about what our demand might be at the grocery store, at the butcher's counter. Are we going to be looking for less expensive cuts of meat? Are we going to shift our tastes more towards chicken and pork? Not our tastes necessarily, but our buying habits, just based on our wallets, right? So that is a concern. The lower cash is reflecting that. But honestly, Michelle, once we get into this grilling season in earnest, I mean, it's we've had some colder temperatures in a big portion of the United States, especially the eastern half. But once we really do warm up and get into spring and that grilling demand comes back, I think that we're going to find that demand once again. And I do think that there can still be new highs coming in the live cattle market further on down the line.
Thanks for your analysis as always, Ted. Ted Seifried, Zaner Ag Hedge with Markets Now.